Have you ever wondered why banks spend billions of dollars on advertising? Why they offer credit cards, personal loans, car loans, and financing for almost everything? After all, banks are some of the richest institutions in the world. So, where does all that money come from? The answer is surprisingly simple. It comes from people who need money the most. And that's why banks often love poor customers. Not because they want to help them, but because poor customers can generate enormous profits. Let me explain. Imagine two people. The first person has $1 million invested. The second person lives paycheck to paycheck. Who do you think makes the bank more money? Most people would assume it's the millionaire, but in many cases, it's actually the person struggling financially. Here's why. A millionaire doesn't need many loans. They can often pay cash for cars. They rarely carry credit card debt. They don't need payday loans. And they usually have enough savings to handle emergencies. In other words, they don't pay many fees. But someone living paycheck to paycheck is different. When an unexpected bill arrives, they may need a loan. When their credit card balance grows, they pay interest. When they miss a payment, they pay penalties. When their account goes negative, they pay overdraft fees. Each of those transactions creates revenue for the bank. And that revenue adds up fast. Think about credit cards. Many people believe banks make money every time you swipe your card. That's partly true, but the real money comes from interest. When someone carries a balance month after month, the bank can charge interest rates that often exceed 20%. That means a small purchase can eventually cost much more than its original price. The longer the debt remains unpaid, the more profitable the customer becomes. And that's exactly what banks want. They don't want customers who borrow money once and immediately pay it back. They want customers who stay in debt for years, because debt creates recurring income. Now, don't get me wrong. Debt itself isn't evil. Used wisely, debt can help people buy homes, start businesses, and build wealth. The problem begins when debt becomes permanent. When people start borrowing to maintain a lifestyle they can't afford. That's where banks start making serious money. And the numbers are staggering. Every year, banks collect billions of dollars from interest payments, fees, and financial charges. A large portion comes from consumers carrying debt. The more debt a customer has, the more profitable they often become. That's why banks constantly encourage borrowing. Pre-approved loans, credit card offers, buy now, pay later programs, easy financing, they're everywhere. Because borrowing fuels the banking business. But here's something interesting. The truly wealthy understand this game. Instead of paying interest, they often receive interest. Instead of borrowing for consumption, they invest in assets. Instead of making banks richer, they make their money work for them. That's a huge difference. Poor people often pay interest. Rich people often earn interest. One side is funding the system, the other side is benefiting from it. And that's why financial education matters. Because once you understand how money flows, you start making different decisions. You stop buying things just because they're easy to finance. You stop carrying unnecessary debt. You start building savings. You start investing. And over time, you move from being a customer who generates profits to someone who owns assets that generate profits. That's the shift. Banks don't become wealthy because people save money. Banks become wealthy because people owe money. And the more people depend on debt, the more profitable the system becomes. So the next time you receive a credit card offer, a loan advertisement, or an easy financing deal, ask yourself one question. Who benefits the most? Because the answer might not be you. And understanding that simple truth could completely change your financial future.